Hi bankers, welcome to another episode of IBS on foreign exchange, which is the A module of the bank financial management for CAIIB examination. We move on to the next concept, that is internal control guidelines or ICG. This internal control guidelines refers to a set of guidelines issued by Reserve Bank of India, which has to be looked into while doing transactions in the dealing room, or the officers who are performing the dealing room operations. They have to go by the set of guidelines issued by Reserve Bank of India. So the purpose of this ICG is ensure functional separation. That means we have seen the dealing room has been divided into three different divisions: the front office, the mid office, and the back office. And each division has got specific work or job to be undertaken, and that is called the functional separation. Then access rule for performing distinct functions. That means the people, the officials posted at the front office, they're not supposed to go to the back office or mid office and do the job of those people. They have to confine to the work allotted to them. So for that, there should be some access rule. That means some login ID, password, and other things will be given. So that means the people posted at the front office, they have to do the job of front office only. They cannot penetrate to the other divisions and do their job. And confidentiality. They have to, while doing the dealing room operations, the data has to be kept confidentially. And global limits for interbank deals should be put in place. There are certain limits for the dealer when they do the transaction. Certain limits have been put, and that has been fixed by the concerned board of the directors. Each bank has got a board of directors, and they will be fixing certain limits which the dealers has to look into while doing the dealing room operations. And adequacy of capital to undertake aggressive dealing activities. We have seen that there are two types of transactions which the dealer does in the dealing room. One is the merchant transaction. Second, the proprietary transaction or the trading transaction. A merchant transaction means a transaction where the customer requests either for a purchase or sale, and the dealer does the transaction. This is called a merchant transaction, or in other words, I can say that the transaction which a dealer does at the request of the customer. That is called a merchant transaction. Second is proprietary transaction or trading transaction. Without the request of a customer, a dealer does buying and selling of foreign currencies. And this transaction, the purpose of this transaction is to make a profit. Because we have seen that the dealing room is acting as a separate profit center. Therefore, profitability is the ultimate objective of any bank. And therefore, within the permitted guidelines and within the permitted operations, they have to make the profit. So for making profit, they have to do the trading transaction. So while doing the trading transaction, they have to look into the capital adequacy also. And that maintenance of the capital adequacy has to be looked into while doing the dealing room operations. Next is for quantifying the market risk and its periodic review. They have to take the appropriate VAR models, value at risk model they have to use. And every dealer should be advised of the limits. So I told you the board will fix limits. So the limit fixed by State Bank of India may be different from those fixed by Union Bank or PNB. Each bank, depending upon their capacity and the volume of transaction they are putting through and the experience of the dealers, they will be fixing the limits. And there are various limits. And what are the limits? One is the overnight limit. Overnight limit refers to when they close the book. How much is the open position? That is called the overnight limit. Next is the daylight limit. Daylight limit means the open position during the working hours. Because Forex transaction as per FEDE guideline, the time is from 9 to 5 p.m., 9 a.m. to 5 p.m. So during the business hours, how much can be the open position? The next slide, I will explain what is meant by the open position. And during the daytime how much can be, and when they close the books how much can be the open position. So one is the daylight limit, another is the overnight limit. And next is the stop loss limit. Stop loss limit refers to the maximum loss that can be suffered by the bank. So the dealer cannot wait when the loss exceeds this stop loss limit. And next is the country limit for each country. Because in Forex transactions, a bank in India will be dealing transaction with various other countries. So the board will fix a limit for US. That means the limit, the transaction with US cannot exceed that particular limit. In UK, there will be another limit. So that is called the country limit. Then NOPL. This is net overnight open position limit. This is nothing but the overnight limit. Net overnight open position limit. Then IGL and AGL. IGL means individual gap limit. AGL aggregate gap limit. Gap limit refers to, gap means a forward transaction, say 1 month forward, and that is covered with a 2-month forward sale. So there is a gap. Purchase is for 1 month, sale is for 2 months. So there is a gap of 1 month. So that gap also, the board is fixing certain limit, and that is called the individual gap limit and aggregate gap limit. Then evaluation of the foreign exchange profit and loss. That is also a very important aspect. When the bank is doing the transaction in Forex transaction, they have to ascertain, they have to assess how much is the profit or how much is the loss. That has to be assessed. And this evaluation of profit has to be done minimum monthly. This is again an ICG, internal control guidelines, and a set of guidelines issued by Reserve Bank of India. And next we'll move on to the dealing room position. I told you the position. What is meant by position? There are a dealer, means who is a dealer? The officials posted at the dealing room. And this dealer will be sitting at the front office or the dealing room. And the officials, there will be one chief dealer. And the chief dealer will be assisted by so many sub-dealers. And in some banks, there will be only one chief dealer who will be looking after all the type of transactions. But in certain bank where the volume is too big, for Forex transaction, there will be one chief dealer. For security transaction, there will be another chief dealer. For money market transactions, there will be another chief dealer. Like that, also it is there. So it all, depending upon the size of the bank, they can have. Now, a dealer has to maintain 2 positions. One is the funds position, and second is the currency position. What is meant by funds position? Funds position refers to the actual debit and credit that is happening in the nostro account. Yesterday, I made a brief comment on what is meant by nostro account. An account maintained by a bank at a foreign center in a foreign currency is termed as the nostro account of bank in India. It is nothing but our account with you. So, for putting through the transaction in dollar, a bank in India, say State Bank of India, they have to maintain an account with, say, Bank of New York or Bank of America or Citibank New York. Therefore, that account is called the nostro account. So here, actually, what are the debits on a particular day and what are the credits taking place in that particular account? And at the end of the day, what is the position? This is called the funds position. So funds position refers to actual inflow and actual outflow. Any account, there will be some debit and some credit. Debit means outflow. Credit to the account means inflow. And what is the net position? And both ready and forward will be happening. Ready transaction means what? Actual debit is taking place. Forward means the debit or credit will be taking place after some time. So it accounts both ready and forward, and mismatch result in interest rate risk. What is meant by mismatch? Mismatch means, suppose on a particular day, the balance in the nostro account is, say, $10,000. So this is the balance. And a particular bank has issued an outward remittance for, say, $50,000. So this instrument will be presented. So there is only balance of 10,000, but this debit they have to make. So when they make the debit, there will be a debit balance of USD 40,000. So what the correspondent bank will do, or the bank where this nostro account is maintained, they will honor the payment and they create an overdraft in the account. Isn't it? So when they create an overdraft in the account, they charge interest for that. So that is number one. Number two, suppose on a particular day when they close the business, there is a balance of say $1 lakh in the account. Remember, the nostro account is a current account where they don't pay any interest. Just like in India, we don't pay any interest for the current account. So this, when they wind up the business on a particular day, if there is a balance of 1 lakh in that account, that balance did not earn any interest. So it is the lookout of the dealer to keep the minimum balance in the account and invest the balance amount in some scheme, some security, where they get at least some interest, 1%, 2%, 2.5%, like that. So that is also the responsibility of the dealer to look into. So mismatch in result in interest rate risk. Overdraft or loss of interest in nostro account. So overdraft means insufficient balance in the account, they have issued a draft or an outward remittance and that payment has come to the bank. Bank will be creating an overdraft and they charge interest. Second is there is a surplus balance in the account that also end up in a loss of interest to the bank. Therefore, it is the responsibility of the dealer to look into all these aspects. Now coming to the second one is the currency position. So this is the funds position, actual debit or credit that is happening in the nostro account. Coming to the funds position, here the funds position, you can have, I can say, totally there are 3 different positions. Or the position, number 1 is a square position. Look, on a particular day, a bank has purchased USD, for example, 100 million, and they have done a sale of USD 100 million. Means the purchase and sale exactly matching. Here there is no risk for the bank. Dealer has correctly squared the position. Or I can say it's a square one, or I can say in this case the position is nil. So when a position is said to be square one, or it is nil, the purchase is equal to the sale. The amount of purchase and the amount of sale in a particular currency is equal on a particular day. We call it is a square position or the position is nil. Second situation, purchase US dollar 100 million, sale US dollar 60 million. In this case, the purchase is more than the sale. And what's the position? The difference is 40 million. This position, purchase is more than the sale. We say it is a long position. Or I can say it is an overbought position. So make it very clear. What's meant by long position or overbought? Overbought, purchase is more than the sale. Third situation, let us assume the purchase is USD 100 million and the sale on a particular day is say USD 130 million. So in this case, the purchase is less than the sale. We say it is a short position. It is oversold position. And what's the position? Here it is minus 30. Purchase is 100, sale is 130. So the difference is 30 million. Here 30 million is purchased, sold more. They have purchased only 100, they sold 130. This is called the short position. So remember, normally the question will come whether it is a long or short. So long position is same as overbought position In that case, a particular period or on a particular day, if the purchase is more than the sale, it is called a long position. If the purchase is less than the sale or the sale is more than the purchase, it's called an oversold position or it's a short position. And here these two situations, long or short, is risky for the bank. Because when they close the business, they close the books on a particular day, and if it's a squared on, there is no risk. Because tomorrow when they open the account, the business, they start the business, we don't know, we cannot predict how much is the value of dollar. Let us assume today when they close, the value of dollar is 85. And in between there is a gap of say 12 hours. During this 12 hours, a lot of transaction takes place in different part of the world. And when you start business next day morning, the value of dollar may be either from 85 maybe to 86 or from 85 maybe to 84 or some 50 paisa, 40 paisa difference. In both cases, it can be a loss to the bank depending upon the position. So that is why the bank will give very clear instruction to the dealer. You have to limit the NOP limit or the overnight open position limit within the prescribed amount. So I think the position limit is clear to you. So reflect the net position of a particular currency, mismatch result in exchange risk, open position, overbought and oversold. Overbought is called long and oversold is short. Example I given for long, 100 million they have purchased, sold 80. So purchase is more. And short means euro 200 million, they sold 250 million. You may raise a doubt. How they have purchased only 200, how they could sell 250? It is possible because the transaction will be, you have even in sport, you get 2 days time. Today you purchase or you sell. If it's a sport transaction, you need to provide the fund only on the second working day. Therefore, it's possible you can have a less purchase and more of sale also. We'll move on to the next one, the risk in dealing room operations. Various risk. Number one, the operational risk. The human error or the infrastructure breakdown, system failure. These are all falls under the operational risk. The exchange risk is called the currency risk. They purchase dollar at 85 and when they sell, it becomes 84. It's a exchange risk, the fluctuation in exchange risk, and this is called the currency risk or exchange risk. Next is the credit risk. What is meant by credit risk? As a banker, you must be knowing what is meant by credit risk. You granted a loan to a customer and he has to pay it in installment, and suppose he default in payment of the installment, bank is facing a credit risk. Same thing here, a commitment has been made, between a contract has been entered, but on due date they are not fulfilling. The counterparty is not completing the contract. Here comes the credit risk, and there the credit risk you can divide into two. One is the pre-settlement risk, another the settlement risk. In pre-settlement risk, neither of the party has transferred the fund. They entered into a contract before due date. One of the party fails or one of the party is backed out. That is called a pre-settlement risk. So here the loss for the other party is minimal. Only because of the fluctuation exchange rate, there may be some loss. But coming to the other one, the settlement risk, which is also called the Herstatt risk. Here the contract is between two parties, but one of the parties, they have performed. And because of the time zone difference, the other party, after receipt of the fund, they fail. That is called a settlement risk. Here the risk for the other party is huge. And here this is also, the settlement risk is also called Herstatt risk, because there was a bank in Germany, Bankers Herstatt, and they have entered into a contract with various banks in US amounting to 200 million US dollar. That was the volume of transactions. You know, there is a time zone difference in US and Germany, because that time it was in 1974. The euro currency has not introduced. European Union has not formed. At that time, the currency of Germany was Deutschmark, and total volume is 200 million US dollar. You imagine. So various banks in US entered into a contract, And the Bank Erste was one of the top banks in Germany. And this Germany bank, Bank Erste, has to give Deutschmark, and in turn, they will give dollar. So what happened because of the time zone difference? The US banks, they are ahead of the time. So they have, by 10 o'clock or by 11 o'clock, they have transferred the fund, and all the money has been received by the Bank Erste by afternoon, because the time zone difference is around 4 to 5 hours. So the banks in US, they have remitted the money to Bank Erste. All the money has been received by the Bank Erste, and they have to make the remittance of Deutschmark. They, after receipt of the entire amount, 200 million US dollar, they failed. They declared bankruptcy. They failed. Willfully they failed and announced a failure of the bank, and they have not remitted the money to the US bank. So the banks in US, they lost heavily, amounting to 200 million US dollar. And that is why the settlement risk is also called the Herstatt risk, because in 1974, the bankers Herstatt, they, after receipt of the money, payment made by the US bank, they became bankrupt or became insolvent. And therefore, that is called the Herstatt risk or settlement risk. And next is the liquidity risk, mismatch in assets, the assets and liabilities. Gap risk, residual time for completion of the transaction. Gap limit refers to, say, 1 month forward and say 3 month sale. So there is a gap of 2 months. So this is a gap limit. That's also involving risk. Interest rate risk, adverse movement of interest rates. Then market risk, adverse movement of the market variables. Equity price risk, volatility in the equity price of the volatility of equity shares held. Legal risk. This is the non-enforceability of the contract. A contract has been entered between two parties, one may be in India, another may be in Japan. And when the contract, say the other party, either one of the parties, they have failed, you can move to the court. The other party, the aggrieved party, can go to the court. When they go to the court, they have to produce the document. If the contract is invalid, then we call it a legal risk. So, non-enforceability of the contract, invalid document. Next is systemic risk, major failure of a bank. Then country risk, a government is putting certain restrictions. We have seen in, say, Sri Lanka or in Pakistan, where they were facing a lot of Forex problem. The government has imposed a certain risk. And this may affect the parties who are doing the transaction with such countries. That is called a country risk, government regulations or political or economic instability. Then sovereign risk. Sovereign risk, it's a sub-risk of the country risk. A particular department of a government, they fail. And then this sovereign risk, you can say it's a sub-risk of the country risk.